Every investor wants to know if a stock is selling for a good price, or if it is overpriced. In most cases, retail investors do not know how to perform complicated mathematical calculations to find out. Today you will learn a simple way to do that. The notions of intrinsic value and margin of safety are critical for young investors to understand. These concepts are behind the strategies used by some of the most successful investors of all time. We will continue the evaluation of Bank of America and American Express that we started in our previous video, Invest Like a Pro Part 1. Remember, this video is for educational purposes only, and it should not be taken as a financial advice. Alright, let's get unlocking. Intrinsic value. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Arthur Fisher. Welcome to part 2 of our series Invest Like a Pro. The intrinsic value of an asset is a measure of its worth. Aspiring investors need to understand that there is a difference between the price of a stock and the value of it. Price is what you pay, and value is what you get. When you purchase a stock, you must pay a set market price. The market price of stocks is determined by a combination of subjective and objective elements, and it represents what market participants are willing to pay for at any given time. But value is what is resident in the asset. And a stock price does not always reflect the underlying business's actual value. Professional investors are always looking for opportunities to buy stocks when market prices are below the company's actual value, or below their intrinsic value. The intrinsic value of a business can be discovered by doing a thorough examination of current and future projections. One big disadvantage retail investors have, when compared to professional investors, is that most retail investors do not know how to calculate a company's intrinsic value. By learning to calculate it, you can largely increase your chances of success. There is no common standard for assessing a company's intrinsic value. Financial analysts develop valuation models based on qualitative, quantitative, and perceptual components of the business. Intrinsic value calculation on financial institutions. One of the most popular methods used by investors to estimate the intrinsic value of a stock is the discounted cash flow or DCF method. The discounted cash flow valuation model aims to determine the current value of an investment based on future forecasts of how much money it will generate. For most businesses, using the DCF method is the tried and tested way. But financial institutions, such as banks, insurance companies, and investment banks, are a different breed. Because of the nature of their capital structure, measuring debt and reinvestment is complex, which makes estimating cash flows especially challenging in the financial sector. Debt, while an unpleasant word, when a corporation owes more than it can afford, has a different meaning in the financial services industry. Instead of seeing it as a source of cash, as most non-financials do, these businesses see it as raw material. To a bank, debt is like inventory to Walmart. It is something they can take and turn into a product they can sell for a profit. Consider Bank of America's debt predicament for a moment. According to Bank of America's balance sheet, deposits from customers into their checking or savings accounts are debt. But should they be? Rather than debt, most financial institutions view these deposits or premiums as raw material for generating further revenue. For example, Bank of America will take your $100 savings account deposit and lend it to another client in order to earn interest on the loan. As a result, the bank will profit from the difference between the interest it collects on loans and the interest it pays on savings accounts. As we saw in our last video, Invest Like a Pro Part 1, Bank of America appeared to have an enormous amount of debt when compared to American Express. And now you know why. This doesn't mean we have to disregard the amount of debt Bank of America has. But it is important to understand each industry's special characteristics as you analyze them. Therefore, for this analysis we will use a different valuation model to find our company's intrinsic value. We will use the Benjamin Graham's valuation model. Ben Graham's formula, the newer approach to security analysis, attempts to value a common stock independently of its market price. If the value found is substantially above or below the current price, the analyst concludes that the issue should be bought or disposed of. This independent value has a variety of names, the most familiar of which is intrinsic value. One way to determine the intrinsic value of a stock is by using Ben Graham's formula from The Intelligent Investor. The Intelligent Investor is undoubtedly the world's most well-known investment book. And, if you are not familiar with Benjamin Graham, he is considered the father of value investing, which simply means buying stocks below their intrinsic value. Graham wrote books like The Intelligent Investor and Security Analysis. He was also Warren Buffett's mentor and a professor at the Columbia Business School, at UCLA, and at the New York Institute of Finance. In his book, The Intelligent Investor, Graham lays out a formula that he used to calculate the intrinsic value of a stock. We will use Google Sheets to break down the formula and set you up for success. However, if you want to download our spreadsheet, feel free to do so. You can access it free of charge in a link in the description below. You will also find our financials ratio evaluation that we discussed in part 1 of our series in the same spreadsheet. Okay. Here is the Benjamin Graham formula to calculate the intrinsic value of a stock, where V represents the intrinsic value, EPS is the company's earning per share trailing 12 months, 8.5 is the PE ratio of a stock with 0% growth, 2 is a growth rate multiplier, G represents the long-term growth rate of the company, and 4.4% is the risk-free interest rate in 1962. But, to adjust to present days, we divide this number by today's AAA corporate bond rate, represented by Y, in the formula above. As we learned in the previous video, earnings per share indicates the profitability of a company. And it is computed by dividing the net income available to common stockholders by the weighted average number of common shares outstanding during the year. Today, we will use the Yahoo Finance website to conduct this evaluation. Let's go to Google. Type in Yahoo Finance. Let me duplicate my tabs in my browser. Type in the name of our first company in the search box. We know that Bank of America's stock ticker is BAC. At the Summary tab, you will find the company's 12-month trailing EPS. As you see, BAC current EPS is 3.51. Now let's check American Express's stock ticker AXB. American Express has a current EPS of 10. Okay. If you are using the same spreadsheet that I shared with you in the description below, the spreadsheet will automatically update that information for you, as long as you have the correct stock ticker plugged in. The next number we will look at is the price-to-earnings ratio, based for a no-growth rate company. It indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company earnings. Graham assigned a value of 8.5 for a PE ratio of a zero-growth stock. A zero-growth stock is a stock that will grow by 0%, or display no growth in the future. However, Graham calculated this a long time ago, and times have changed since then. We can adjust 8.5 to today's reality. The price-to-earnings ratio, for a company which is not going to grow in the future, can be found by dividing 1 by the company's cost of equity. If we use the dividend growth formula, we can use the capital asset pricing model, CAPM, to find out what is the cost of equity for our companies. Let's go to Google to check the current cost of equity for Bank of America. Here, we can see that the cost of equity for Bank of America is 8.5%. Now, let us check the cost of equity for American Express. Okay. The cost of equity for American Express is a 9.34%. Let's get back to our spreadsheet. As I said before, you can adjust the PE ratio of a zero-growth stock by dividing 1 by the cost of capital. The adjusted PE ratio of a zero-growth stock for Bank of America is approximately 11.75. The adjusted PE ratio of a zero-growth stock for American Express is approximately 10.75. The next step in the formula is to find the growth rate for both companies. Let's go back to the Yahoo Finance website. Open the tab Analysis. Scroll down. We will see here that analysts are predicting that in the next 5 years, that American Express will grow at a rate of 14% per year. Bank of America will grow at a rate of 15.4% per year. Remember, if you feel that the number is too conservative or too optimistic, you can change the number to reflect what your estimate is. I will be a little more conservative, and I will deduct 2% for the growth estimates from both companies. Alright, let's keep moving. The number 2 in 2G is the multiplier Graham used in his formula for this growth rate. In the 1960s and 1970s, Graham hardly experienced growth rates of 15 to 20% from companies. There were just not many companies in his time with such high growth rates. Therefore, a growth multiplier of 2 was quite reasonable. However, higher growth rates are very common nowadays. So, instead of 2, we will reduce our multiplier to 1. To be more conservative and safer in our estimates. The last number we need to find, to complete our formula, is the current yield of a AAA corporate bond, represented by Y in the formula. Let's go back to Google and search for the current yield of a AAA corporate bond. And click on Moody's charts. As we see, the current rate is 4.13%. Please keep in mind that this rate changes frequently. As you see, the intrinsic value of Bank of America is $94.05. That's how much Bank of America is worth per share. And the intrinsic value of American Express is $241.89. Meaning American Express stock is worth $241.89 per share. Bank of America current price is $36.59. And American Express current price is $168.19. Therefore, both companies are selling at a considerable discount. When we look at both stocks' current prices, Bank of America is selling at approximately 60% below its intrinsic value, and American Express is selling at approximately 30% discount below its intrinsic value. Which brings me to the next step. Margin of safety. Graham advises investors to take one step forward in order to increase the chances of a successful investment. He advises investors to add a margin of safety before making a decision whether to buy a security or not. A margin of safety is simply buying a stock at a significant discount to its intrinsic value. It's an investment built-in cushion, so to speak. The intention is to minimize the downside and maximize high return opportunities. Graham's goal was to buy assets worth $1 for 50 cents. In other words, he used a 50% margin of safety on top of the intrinsic value. Warren Buffett himself has said that the 3 most important words in investing are margin of safety. To calculate a margin of safety, we need to know the security's current price and its intrinsic value. Our spreadsheet automatically gives you the stock current price, assuming you have inserted the correct stock ticker. To find out the difference between the current price and the intrinsic value, we divide the current price by the intrinsic value. I have already made that calculation very simple for you in the spreadsheet. All you have to do is to choose a margin of safety that you want to work with. We will use a margin of safety of 50% in our evaluation. Meaning, a 50% discount on top of the stock's intrinsic value. A margin of safety of 50% is the same margin that Graham's used to apply while trying to achieve his goal of buying assets that are worth $1 for 50 cents. Remember, it always pays to have a good margin of safety of at least 30 to 50%. To find out what is the acceptable buy price of the stock, you will multiply the margin of safety by its intrinsic value. And anything below the acceptable buy price should represent a very good value, according to Benjamin Graham's formula. After applying a margin of safety for both stocks, we see that Bank of America's current price is selling below the acceptable buy price, making it a good entry opportunity. And American Express, even though is selling at a discount, 30% below its intrinsic value. It didn't pass the 50% margin of safety test. Therefore, in theory, an investor looking to minimize downside and maximize high return opportunities would choose to invest his money in Bank of America instead of American Express, as Bank of America is selling at approximately 60% discount below its intrinsic value. Here, at Investing Unlocked, our mission is to help educate one person at a time and empower people with the knowledge and tools to make better financial decisions. If you want to get smarter about investing and be part of our community, please press the like and subscribe buttons. Key takeaways. Alright. Let's quickly recapitulate what we learned in the first part of our series, Invest Like a Pro, Part 1. In the first part of our analysis, we conducted an examination of some critical financial ratios of Bank of America and American Express stocks. After analyzing both stocks, we found that Bank of America stock appeared to be selling at a greater value and with a higher dividend payout. And American Express appeared to be doing a better job in terms of profitability and liquidity. As we dug deeper into the analysis, in this second part of our series, we learned that Bank of America's apparently elevated current ratio and debt-to-equity ratios can be explained, in part by the nature of its business model. We learned that debt is a form of raw material for them. It's something they can take it and turn into a product that they can sell for a profit. The next step of our analysis consisted in calculating both companies' intrinsic value. We found that the intrinsic value of Bank of America is $94.05, and the intrinsic value of American Express is $241.89. During our analysis, we found that both companies are selling at a considerable discount when we look at both stocks' current prices. Bank of America is selling at approximately 60% below its intrinsic value, and American Express is selling at approximately 30% below its intrinsic value. But only Bank of America passed the 50% margin of safety test. Therefore, between Bank of America and American Express, Bank of America stock would likely be a good candidate for Benjamin Graham to buy. What about you? What do you think? Based on our evaluation, which stock do you think is a better investment? Leave a comment below. Remember, Graham's formula is one way to assess a company's intrinsic value. But there are other popular ways, such as the discount cash flow analysis, DCF, and the Gordon Growth Model, GGM. Please keep in mind that the correct valuation of a stock's intrinsic value depends on numerous assumptions and the proper security analyst's estimates of future growth rates. Investors are also advised to perform a company's qualitative analysis before buying any stock. Investors should look into the company's industry trends, technology disruption, economic moat, and the quality of the management team. The performance quoted represents past performance and does not guarantee future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when sold or redeemed, may be worth more or less than the original cost. Good investing. See you next time.